Rich, good morning. It's great to have you with us. Are you too late for this, I wonder? Semis and software, the two ETFs that you like, they've already bounced 18 and 21% from their 52-week lows.
Yeah, look, I think that's a very fair question, and one clearly I've gotten from just about every one of my clients here, which is only natural after the strong surge off the lows. But I think there's two setups here, Deirdre, and the structural setup is still quite compelling. When you look in the short term, obviously, we talked about the surge off the lows, which has left us overbought into resistance in this period of weak seasonality, in a downtrend with CPI tomorrow. I mean, how could you possibly buy stocks? Well, I'll tell you how you buy them. You zoom out and you look at the weekly chart. You look at a longer-term chart, and this is exactly where you have been paid to back up the truck on technology at every major market low since the financial crisis. And by that, I mean those longer-term weekly moving averages that have defined the post-financial crisis bull market. In addition, you have a compelling setup from the top-down macro vis-a-vis peaks in gasoline, peaks in crude oil, and bottoms in high-yield credit. So we have tops in the top down, which has created this bear market, and you have bottoms from the bottom up in stocks, the top 12 years of support with MACD buy signals for the first time in the bear market. So yes, short term, it's later than we would have liked. There's always room for improvement at these major market turning points. But again, there is plenty of upside. And the three most dangerous words in this business are, I missed it. You have not missed it.
Well, we talked to a lot of people, too, that also argue that this is a bear market rally. And when we saw the dot-com bubble burst, there were many of those. What makes you so confident? You said that energy has peaked. What makes you confident of that? And also that valuations have settled.
Yeah, look, there's a lot to unpack here. First, I'll start with the last, which is valuation, which really means very, very little to nothing to the technician. But I would say this, admittedly, you can still make the case that this is a bear market rally. But, you know, the risk here is to the upside from the standpoint of not being there when the market goes up rather than being there if it goes down again. Keep in mind where sentiment and positioning are. They border on draconian, myself included until just last week. I'm not trying to pretend like I've been a big bull here. In fact, been quite bearish until this last turn here on Thursday. But what I'm telling you is that who's left to sell? And I don't mean to jinx this burgeoning bull off the bottom here, but only to suggest that we know that positioning is at its lowest levels in quite some time. We know that sentiment is at its lowest levels in quite some time. The narrative of the Fed has to keep going. I mean, everybody, including myself until just recently, can tell the same tale of woe. And that's the type of backdrop from a sentiment and positioning standpoint that occurs at major market lows when you're sitting there on that same structural support that has defined this bull market and is likely to do so again with this new cyclical bull phase.